أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. Chapter 6, which is about inventory, reporting and analyzing inventory, and it's a fairly short and straightforward, easy chapter, inshallah. Maybe we can finish a bit early and let you go and study for your finance exam. Okay. The inventory is classified for different types of companies differently. There are two types of companies when it comes to inventories, companies that have inventory. One is merchandising, the other is manufacturing. There's a third type of company, which is service company. They don't have inventory. For example, providing cleaning service, security service, accounting service, legal service. They don't have anything to sell, or they don't make anything. Merchandising companies buy the inventory, finished goods inventory, and they sell the finished goods inventory. For example, Lulu, Carrefour, they buy a bottle of shampoo, they sell a bottle of shampoo, they don't do anything to it. It's just one type of inventory, and that's the finished goods inventory. Second type of company is a manufacturing company. They have three different types of inventory. Buy raw material and they make something, right? For example, a phone company like Apple, computer company like Apple, they make phones, computers, etc. They buy raw material, right? Toyota is a manufacturing company. They buy raw material and they make finished goods. They have three different types of inventory. Raw material inventory, the raw material that they buy. There's a second type, which is called work in process, meaning half-built items. So let's say Toyota started to build a car. At the end of the day, they did not finish building the car. They did not finish making the car. That is going to be classified as work in process inventory, right? Halfway finished goods. And then the finished goods inventory, right? All inventories are reported in the balance sheet under the current assets, no matter what the type of the inventory is. All inventory are reported in the balance sheet under current assets because it will be used immediately, right? It will be used immediately. And last week, we looked at the inventory turnover, meaning when I say inventory turnover is 6, what does that mean?
Like the amount that they're turning over to the amount they're selling, they're buying new inventory and selling.
Right. So when I say 6, what does that mean?
They've done that 6 times within the year.
6 times during the year. Very good. So every 2 months, the inventory is sold to inventory purchase, right? So it's in the current assets. It doesn't even take 12 months, right? Every 2 months, if I say 6, if I say 12, that means every month they're selling, right? You follow? So think about a company such as Papa John's. They buy the tomato to make the pizza. How long is the tomato going to last? 1 week, maximum 2 weeks, right? 2 weeks, it's not going to last. If you put a 2-week-old on the pizza, they get the tomatoes and the other vegetables. If they get it fresh, they get it usually twice a week. So 3-4 days old. So that inventory sells twice a week, let's say. That means 8 times a month. You follow, right? That means the inventory turnover, if you look at it if it's 8 times a month, right? Right. So 90, it will be 96 for the year. You follow what I'm saying, right? And again, we are not going to do that type of merchandise when they have this type of short shelf life. But the point is, it is always current assets. It doesn't take a whole year even to sell the inventory. All right. We talked about briefly the perpetual inventory system and the periodic inventory system in a previous chapter, if you remember. Right. The difference between perpetual inventory and periodic inventory is, in the perpetual inventory, you take an ending inventory, you take a physical ending inventory to calculate the cost of goods sold. Right. So you have the beginning inventory, you have the purchases, and then you have the ending inventory. You have to do that in perpetual inventory system in order for you to calculate the cost of goods sold. So a physical inventory is always taken, right, in both, in perpetual as well as periodic, right? I made a mistake. Periodic inventory is where you calculate the cost of goods sold with the ending inventory, not perpetual, right? But in the perpetual inventory, you also take the ending inventory because you want to check the accuracy of the inventory records. So if you're just keeping track of the records without physically counting, periodically, meaning every now and then you have to count the inventory to make sure that the actual physical counted inventory is equal to the inventory you have in your accounting records. You do that for both, right? In periodic, it is necessary to calculate the cost of goods sold. In perpetual, you keep track of the cost of goods sold by calculating the cost of goods sold every time you sell. The way you did the accounting information cycle entries, inventory system did you use? Perpetual, because you had two entries: debit cash, credit sales, debit inventory, I'm sorry, debit cost of goods sold, credit inventory. This is perpetual, right? So cost of goods sold is calculated every time you make a sale. But in this case, also physical inventory is taken, right, to make sure that you have actually present the inventory that you have counted with the entries, that nobody is stealing the inventory, or there is no shoplifting or theft or waste otherwise. If you don't take the physical inventory, then your waste or your theft will go undetected. For the periodic inventory, you have to do it to calculate the cost of goods sold, right? Beginning inventory plus purchases minus ending inventory equals cost of goods sold. So you have to calculate the ending inventory, but it also, counting the physical inventory always is good, even if you're not following, even if you're not doing the periodic inventory system. Now, taking a physical inventory, it involves a lot of hard work, and it's difficult to do, and it is usually done when the business is slow. It is usually done when the business is, if the business ever closes, then it is best to do it when the business is closed, that right, there is no business transactions going on. Because if you do the physical inventory when you're buying and selling, then by the time you start counting the inventory, from the time you start counting the inventory to the time when you stop counting the inventory, the entire period of counting this inventory, your inventory will have changed because you're selling at the same time. So your inventory is going down if you go from one department to the other. So physical inventory is taken either when the business is closed, and if the business is never closed, for example, Walmart, so 24 hours operation. So inventory is counted at the middle of the night, right? 2 a.m., 3 a.m., when the shop is all empty on a weekday, let's say, right? So this is how the inventory is taken, and it is at the end of the accounting period. The physical inventory is taken at the end of the accounting period. And I may have shared with you that I took physical inventory at a convenience store. I worked 8 days. We have Bukud here. I may have told you this, right? I worked at a Chevron in the US for 8 nights when I was a student, and that's it. I didn't want to do that because it was a night shift job from 10 p.m. at night until 6 a.m. And they took certain items inventory every day, right? For example, cigarettes, they counted every day because there is a possibility of theft, high possibility of theft. So, you know, they have maybe 25 different brands of cigarettes and so forth, it's a nightmare to count that. You have to do that daily, right? They have, you have been to Sidra, the shop with Ukud. Just think about the different types of candies and chips and cookies and so forth. All of them are different categories of inventory. You have open packets, and then you have whole packets. Whole packets are easy to count because you know that there's supposed to be 24 boxes in this, or there's supposed to be 20 sticks of gum there. But if it's an open packet, you have to physically count the open packets. It's just a nightmare. You follow? So physical inventory is a very detailed and tough thing to do, but the business has to do it periodically, not every day of every item. Certain expensive or more vulnerable items are taken more frequently, but usually maybe 6 months, 3 months, if you are doing perpetual inventory. For periodic inventory, if you report monthly cost of goods sold, then you have to do it at the every month, right? If you report monthly cost of goods sold for periodic inventory, you have to do, otherwise you cannot calculate cost of goods sold, right? Which is the second item on the income statement, sales minus cost of goods sold. Okay. Physical inventory must be counted manually. You have to physically see that it is present. A human being, you can send a robot if you have a robot that can do that, but it has to be physically, because the inventory is, right? Even if you use barcode scanners to scan the actual box, you have to go to the box. You have to go to each box, right? So physically, you have to, when you're counting something physically, right? You cannot sit at a desk and count, right? You have to physically, if you follow, even if you have technology, you have to go to each item, right? So it is a bit of a task to do, and hopefully you won't have to ever do it, inshallah. If you're an accountant and if you go into auditing, then you have to count physical inventory, right? You have to count physical inventory, but the good news is you don't have to count everything. You can take a sample and you count and see whether the sample has all the items it's supposed to have, right? So if they say that each shelf has 2,000 boxes, so you can take one shelf and see if they have 2,000, or two shelves take, say, 2,000 in each, then you can conclude that, okay, the other shelves randomly pick, right? If they say each box should have 24, calculators, you can open 10 boxes and count them instead of all the 2,000 boxes, right? And then take a sample when you're counting, right? As an auditor, you don't have to do it because you're not going to do auditing, inshallah, but who knows? The ownership of the inventory is determined in a few different ways. The goods that are in transit, right? The goods that are in transit, so the buyer purchases the inventory and the seller sells the inventory, and the inventory is on the way. So who's the owner of the inventory, right? Who's the owner of the inventory? It depends on when the actual ownership transfers to the buyer from the seller, and it depends on the terms, the sales terms, right? So let's say if you have the arrangement FOB shipping point, right? FOB shipping point, meaning it's free on board at the shipping point, which means who's paying for it? Free on board shipping point means who's paying for it? The buyer. It is free at the shipping point means wherever it's shipped, it is not paid. The shipment is not paid. The shipment is paid on the other end. Are you following? FOB shipping point means the buyer is paying for it because it's free when it is shipped. The seller does not have to pay for the shipment. Are you following? If that is the case, the ownership of the inventory transfers to the buyer as soon as it gets on the truck, as soon as it gets on the vehicle that will transfer the items, that will ship the items. So, at that point, the owner of the inventory is the buyer and they can include that in their inventory. But if it is FOB destination, that means the seller is paying for it, the ownership does not transfer until it has reached the destination, right? FOB destination means it is free at the destination. The shipping is paid for, the shipment is paid for by the seller. Are you following? Okay, so ownership changes at that time. So you have to keep in mind when you have the descriptions that the shipment is made on December 29th, FOB shipping point, right? And it does not arrive until January 5th. On December 1st, who owns the inventory? So you have to know when did the ownership change. All right? FOB shipping point, think about it this way. If it is FOB shipping point, then think about it this way. The buyer sends the truck to get it. The shipper does not have to pay. It is free for the shipper. As soon as the truck gets the item, the buyer is the owner. FOB destination is the seller's truck will go to the buyer. So as long as this truck has the item which belongs to the seller, it is free shipment to the buyer. The ownership of the good does not change until it reaches the destination, right? So FOB destination, the ownership transfers at the destination. FOB shipping, the ownership transfers at the shipping. Clear? There is something else called consigned goods. Consigned goods. So if you have inventory that is in your location, but it does not belong to you, right? Then that should not be included in your records. For example, let's say I open up a company making cookies, right? Making cookies, I have a box of cookies, and I ask Lulu to display some of my cookies in their shop. They don't have to pay me anything. I will just put it in their shelf, right? If they sell, they can keep a profit and give me my cost. You follow? If they did not pay me for that inventory and that inventory is sitting on their shelves for the customers to buy, who owns this inventory? I own them, right? Because if the customer doesn't buy, I will take it back, right? You follow? Right? I will take it back. So if you have inventory in your location that does not belong to you, right? That means you should not include that in your inventory records. But if you have inventory that belongs to you, but it is in somebody else's location, right? Then it should be included in your records. You follow? Similarly, if you sell inventory and you have received the payment and you are just holding the inventory until the buyer comes and gets it, right? So let's say you sell a car, right? You sell a car and the buyer says, I will take the delivery, I will come and take the car next week. And the buyer paid for the car, right? The buyer gave you complete full payment and you gave them the ownership documents. The car is just sitting in your location. Who owns this inventory? Right, so who is going to show that inventory in their records? The buyer, right? the seller does not own this inventory. So you have to have ownership of the inventory regardless of the location of the inventory for you to include it in your records. You following? Right? Of course, right? Because it's paid, right? Is that clear? There are different methods of keeping account of the cost of the inventory, and these methods affect the inventory amount on the balance sheet, the cost of goods sold on the income statement, and the gross profit as well as net income on the income statement. And these are methods of accounting for the cost of the inventory, not necessarily always physical movement of the inventory. Not necessarily always physical movement of the inventory, but the cost. And what does this mean? What I just said, what does it mean? I'm going to explain to you. There's two different things. One is the physical movement of the inventory, and the other one is the cost of the inventory. Okay, so the first one is specific identification. You can identify the inventory specifically, and you can calculate the cost of goods sold. And usually this is done for big items, big ticket items, right? So let's say you have large electronics or cars or boats, right? Things like that, large items, you can do physical specific identification. So let's say you bought or you built a boat and it costs you 10,000 and you're selling that specific boat for 12,000. So you can calculate that this is the cost and this is the sales price. So 12,000 is the sales price, cost of goods sold is 10,000. I specifically identify that this is the boat that cost me 10,000. Another boat could be 9,000 or 10,000. And you specifically identify that. This is called specific identification. The difference between how much you sell and how much it costs you is going to be your gross profit. No, the cost is the cost of goods sold, right? Sales minus cost of goods sold is gross profit. Sales minus cost of goods sold is gross profit, right? So specific identification, it's done for big items. You cannot do it for bottles of milk, for example. You cannot do, right? You're selling hundreds of bottles of milk. You don't know which one you paid for how much. You follow. You may have purchased them at points for different prices. It is possible, right? It's possible that you purchase them for different prices at different points in time. First in, first out is you calculate the inventory cost based on the first one you received, and the first one you sell is considered the first one you received. So let's say you buy 10 bottles of milk today, 10 bottles of milk tomorrow, another 10 bottles of milk the day after. When you sell the first 10, you will go to the old one, right? You're going to say that I'm selling the oldest one. So whatever it cost you to buy the oldest, the first 10, we're going to do this with more numbers, inshallah, it will make more sense. You the oldest batch and you sell that first when you calculate the cost. Last in, first out is the last items you have received, you consider them to be sold first. You follow? Now, you can calculate anything using last in, first out. You don't necessarily have to sell physically the last items you purchased first. For example, milk, no matter how you count it, you have to sell the first one first. Otherwise, it will expire. Vegetables, fruits, food items, right? Can you give me an example of last in, first out? You don't have to sell the last one first.
The opposite.
You don't have to sell the last one first. This is usually done for items that are piled. Items that are piled. For example, coal. You know coal? When it's mined, you heap. So you put the old coal, new coal over the old one. So it is heaped on top of the older one. You follow, right? Coal. You know what coal is, right? Faham. COL, coal, right? Any type of mining, if you dig from a mine, you pile them, make a heap of it, so you have to sell the one from the top. You cannot go to the bottom, right? That is last in, first out physically. Doesn't have anything to do with how you count it, right? How you account for it physically. And then you have average cost, which is you just take average cost of all the items you have at hand at any point in time, and you calculate the cost of goods sold. So if you buy one for 8 riyals, another one for 9 riyals, another one for 10 riyals, average is 9, so you consider the cost to be 9 for no matter which one you sell. This is called the average cost, right? So physically, right, can you think of an example where things just get so much mixed that you cannot separate them? You have to do average cost physically. Shampoo? Shampoos come in bottle, right? So you can. Petrol. The old petrol is mixed with the new petrol, right? So they all get mixed. You cannot specifically identify, even if you purchased batch for a higher price than the other, one truck of petrol higher than the others, it gets mixed in there, right? It's a liquid, so you cannot specifically identify. You don't last one, first one, last out, first out. You cannot, right? So it's all mixed together, right? Physically, but again, the physical aspect is something different than how you count for it. You can do inventory for milk when it comes to accounting for the inventory using last in, first out, or average, right? You follow? Okay, so let's go into some examples. Yes, it does make a difference. It does make a difference in the net income, and it does make a difference in net income when prices are increasing, when prices are decreasing, right? It makes a difference which method you're using, right? And seldom are prices stable over a long period of time. Over a long period of time, prices are not stable. They are going one way or the other usually. There is usually up and down, right? For many items, right? Seldom, right? The only thing that has not changed since I've come to Qatar in 2011 is the cup of karak. It's 1 riyal, it's still 1 riyal, right? With or without the virus, it's 1 riyal, right? So everything else has changed. The petrol has gone up and down, right? Gold up and down, milk, huge up and down, right? So eggs and so forth. So let's take a look at an example. This TV company purchases 3 identical 50-inch TVs on different dates for 3 different prices. So we have 3 different TVs, 700, 750, and 800 on 3 different days, right? We can specifically identify each TV. So let's say we have these 3 TVs, each of them, right, are identified with a price that, TV number so and so is for 700, so and so for 750, so and so for 800. And when you calculate the cost of goods sold, right, if you sell each one for that 1,000 or whatever it is that you're selling them for, you can calculate the cost of goods sold, the gross profit, by subtracting the actual exact amount of cost of goods sold, actual exact cost that you paid, because you know that I bought this TV for 700, I'm selling this for 1,000, therefore my gross profit is 300 from this TV. I purchased this TV for 800 and I'm selling it for 1,000, my cost of my gross profit is 200 from this one specifically. So this is specific identification. You can do with big items, big electronics, etc. And this. No, there is no, yes, there is no, it doesn't matter, it's not first in, first out or last in, it's specifically, you know, that, okay, I purchased this and I'm selling this, so my profit from this is 200 because I purchased it for 800 and for 1,000 specifically. And this specific identification is both ways. It is actually physically as well as accounting. The same. You know physically this TV was purchased for 800 and you're physically selling this. So the physical inventory movement as well as the accounting is the same, right? Are the same. Are you following? So this practice, as you can tell, is rare, right? Even in the case of TVs, because companies don't carry 3 TVs, right? Or 3 computers, they have hundreds. So this practice is rare, right? The distribution of the companies, yes.
When we bought this, when the items had different price, and I choose to sell the one that cost me more at the beginning, doesn't this make like revenue higher than the decide? Yeah, that's what I'm asking. Do I have a choice which one to let it out first?
If it is specific identification, the buyer will choose. If it is first in, first out, then it doesn't matter what the buyer chooses. You will consider that you sold the first one you purchased first. Okay? You choose the first one you purchased first. Now, you asked a very intelligent question. It will come later, but I will answer this question. You might understand it now. If I'm using first in, first out, and prices are increasing, right? So I bought the first bottle of milk for 5 riyals, the second bottle of milk for 6 riyals, the third bottle of milk for 7 riyals, and I'm selling one of them for 10 riyals. If I use first in, first out, then I will show more profit because I will subtract 5 from the 10 and my profit will be 5. If I use last in, first out, then I am going to sell the 7 riyal bottle first. So my profit only is going to be 3. So when prices are increasing, first in, first out will give me more profit. If prices are decreasing, last in, first out will give me the maximum profit. So that is why you cannot switch between FIFO and LIFO from year to year to show more profit as you please. You have to decide what you want, which one is better for you, and you have to stick so that last year's profits can be compared to this year's profit. You can do a horizontal analysis which makes sense. You're comparing apples with apples, right? You're taking your height without any shoes this year. You're taking your height without any shoes the next year. You follow? If you're wearing shoes one of these years, and you say, well, look, you know, I'm really taller than last year. It is not a comparison. It's false. The comparison is false. Do you follow? Right? And this, again, we are going to go into deep into this. I will, inshallah, leave you with a very deep knowledge of this, inshallah. The financial statements that I have posted in Blackboard, you may have seen. This is a real company financial statement, a one unit Domino's pizza store which is a client of the firm that I used to work for, and my boss sent it to me. So you can see the comparison between last year's performance and this year's performance when the pandemic hit. You can see what happened, right? Comparing the two. Okay. Generally, most companies use FIFO. Most companies use FIFO. A few companies use LIFO. Fewer companies use average cost, and then there are some other methods of using the inventory. So this is just a statistics. It changes, of course, from time to time, but this is a general idea of how most companies operate. So let's take a look at, we looked at specific identification, right? We looked at specific identification, the 3 TVs, 700, 750, 800. Now let's take a look at first in, first out. So this is a list of items that were purchased with their quantities and unit prices. So as you can see, prices are going up. $10, $11, $12, $13. So this is the price of each item, right? Whatever the item is, electronics, food. The unit cost was $10 January 1. It was $11 April 15th, $12 August 24th, $13 November 27. So this is the number of items, 100 units, 200, 300, 400. They have 1,000 items that they had, and they sold 550 items, right? Their ending inventory was 450. So the question is, if we use FIFO, how are we going to calculate? How are we going to calculate the cost of goods sold? So 550, right? If I say FIFO, I'm going to sell the first 100 first, right? Are you following? So write this down, do this calculation. So the first 100, the cost is 1,000, right? I'm going to sell that first. Are you following? Then I'm going to sell this 200. The cost of that is 1,200, right? Then I'm going to sell, I have 100 plus 200, which is 300. I need how many more? 250, because I'm selling 550. I sold 100, I sold 200, so I sold 300 together, right? Try to do it in your head a little bit. So I'm going to sell 250 from these, right? That means my cost is going to be 250 times 12, right? 250 times 12. So do the math. Do the 250 times 12. How much is it? Use your calculator. How much? 3,000. So what is my cost of goods sold? 6,200. Say that again. 6,100? 200. 6,200. Right. Very good. So 1,000 plus 2,200 plus 3,000. Miss Mai, are you following? Are you following? Okay. Can you explain to her? No. I cannot move without you understanding, and I think she will be able to explain to you better and quickly than I will individually. So can you go to her? You need wear your mask and go to her. Miss Mai, don't have a mask? Wear a mask. Wear a mask. Right? We call this peer instructions, right? It works better sometimes than the instruction from the instructor. Okay, sit down there, sit beside her, take 2 minutes and explain to her how to calculate the 6,200. Where do we get the 6,200? The others, you check your phone, messages, text messages, or purchase something from somewhere online, whatever you like to do. Give her 2 minutes and she will be with us, inshallah. And for those who are watching this episode from home, you're missing out. For the people who will listen to this. Look how sensitive this is. Clear? Piece of cake, yeah? Very good. So this slide explains what we just discussed, right? How to calculate this, right? We have to go to, yes.
Where it says minus ending inventory.
Right. We haven't completed the calculation. We just calculate the cost of goods sold. So we are going to do the calculation. We just calculate the cost of goods sold. We still have calculations left. So what we did, what? The items we sold is what we calculated. Okay? So now, here,
But then in the previous slide, it says that the beginning inventory plus minus the ending inventory equals the cost of goods sold.
yes,
So what does this number 6,000?
I will show you. This is the cost of goods sold. I showed you the calculation of the cost of goods sold. When you're calculating the equation like that, you will calculate the inventory that is left. You'll go from the bottom and calculate what is left. It will result in the same thing. But visualizing the first in, first out is easier to calculate when you go to the first. The calculation is done from the bottom. I'm going to, you will know how it comes. It will come together, inshallah. And if you still don't understand, I will explain, re-explain, inshallah. So here it is, right? You see, calculated 6,200, right? The calculation actually is you have 450 units left, right? So you calculate the ending inventory, right? Because the ending inventory is left, which is 450. Are you following? So you do the 400 units that is left first, which is 5,200 that is left in your ending inventory, and then 50 items from this, which is left in your ending inventory. If you add those two, you will get 5,800, right? The same concept. You sell the first ones, that means you have the last ones in the inventory. So you can calculate the ending inventory by going bottom up, right? If you're calculating cost of goods sold, you can come from top down. You sold 550 items, you have 450 left. So the ending inventory is calculated in the first in, first out from the bottom because that is left, right? The result is going to be the same. The cost of goods sold is going to be 6,200. Are you following? Where does that 5,800 come from? It comes from the 400 units at 5,200 and then 50 units at $12, right? At $12. Are you following? Is it clear? So Muhammad, is good? Good? You follow? How do we get 5,800? We get it from the 450 that is in the ending inventory that we did not sell. Okay? So you follow? 400 is, the 400 items is $5,200, the last line. Right? That is the cost of the ending inventory. Plus another 50 items from the line before. So 50 times 12, how much is it? 50 times 12? 600. Right? 600 plus 5,200 is 5,800. You follow? So I sold 6,200 and I have 5,800. How do we calculate it? I have 12,000. I have left 5,800. That means I sold 6,200. So the cost of goods sold is 6,200. No matter how you calculate it, right? I can calculate any inventory and the cost of goods sold, or you calculate the cost of goods sold directly, right? It's going to result the same, in the same way. No. It's first in, first out. It is left. It is not sold. It is not out. It is in the ending inventory. Yeah, I did not sell it. It's in my ending inventory. 5,800 is ending inventory. I did not sell it. It is still with you. Oh, right? Is that clear? This is first in, first out. If you understand this first one, the next one is clear, inshallah. Okay. So for those viewers watching outside, let's go back here. So here we have, Mr. Muhammad, you can look at this illustration, it might make sense. This 5,800 is still in my warehouse, I did not sell, right? And this 6,200 is sold, it's on its way, right? You follow? So this 400 units that I calculated still sitting in my warehouse, it's not out. It is last in and it's still in. You follow? The first in is out, it's gone. Clear? Inshallah, you do a few problems, it will become piece of cake. This is not difficult, inshallah, at all. You have already done more difficult things than this already you have done here, okay? So this is nothing, inshallah. Okay, first in, first out is the opposite, right? The opposite, you calculate the cost of goods sold from the bottom and the ending inventory from the top. Rarely is it physically last in, first out, rarely. And I gave you a couple of examples because this does not happen regularly. You don't sell the older items. Otherwise, the oldest one you will never sell unless you sell everything, right? And you never sell everything, right? You follow? You always buy inventory when you have inventory. You don't sell everything and then go buy inventory. So if you actually physically have last in, first out, you'll never sell the last. That's exactly what happens in the coal mine. Some items actually, as they get older, they increase in value. There are some minerals and so forth. If you keep them longer, they increase in value, right? And I'm not an expert, I couldn't tell you what exactly it is, but there are some, right? Okay, so let's take a look at the physical count of this inventory, and I'm not going to make you go through this calculation. Again, you can You can just observe it. It's easy. So here, the same concept here as you see, purchase, purchase, purchase. You have this same numbers, but see how the cost of goods sold is calculated. The cost of goods sold is calculated from the bottom and the inventory is calculated from top. So this 5,400 inventory calculated from top. So you have 1,000, you have 2,200, and then you have 150 from this third, right? Because we have 450 left, right? So can you calculate this 5,400, where this comes from? Calculate this, 5,400. Do you see it? Do you find 5,400? Ending inventory. Our ending inventory is 450 units, right? 450 units, right? So we have 1,000, and then we have 2,200. How many units is that? 100, 200, right? That's 300, right? I need 150 more. So that is $12 times 150 times $12 equals to how much? 1,800. Huh?
We're doing last.
Oh, we are not less in first out. I'm sorry. This is not less in first out. This is average cost. I'm sorry. I'm sorry. This is not less in first out. I'm sorry. This is average cost. Average cost. So they're doing average cost. The average cost is.
But there is one slide. Yeah, you missed this slide.
There was a LIFO.
Yeah.
Oh, here it is. Okay. So here, okay. So here we have 1,000, 2,200, and 1,800. So we have 5,000. So this is the last in first. Thank you. So this is the last in first out. We go from the calculation of inventory comes from top 100, 200, and 150. So it's 5,000 and 5,000. This is the ending inventory calculation. Ending inventory calculation. Ending inventory. If I do down cost of goods sold from bottom up, right? I'm going to have the same. The result is going to be yes. Yeah, 400. Same number, except the method is the same. Method is the same, right? So this is the ending inventory. It's not the cost of goods sold. If I do cost of goods sold with 7,000, how do I do that? 5,200 plus. So 400 units, and then I have. I need how many? I need 150, right? 150 multiplied by. Because I have 550, right? So 150 times 12 is 1,800, right? So we have 7,000. The cost of goods sold is 7,000, and this is ending inventory. Are you following? Is it clear? Did I confuse you? I'm sorry. Is it clear? Okay? Okay. Now, so the average cost is the easiest. You just take the average cost at hand. So you have $12,000 is the cost. Divide that with 1,000, and average cost is 12. That's it. Multiply the number of units you have sold or the number of items available at the end with the average cost, and you get the 5,400, right? You multiply 450 with 12, and you get this. You multiply 550 with 12, and you will get this. Is that clear? This is average cost, right? Average cost, the total cost is 12,000. The total cost is 12,000, right? And you have 1,000 units, right? The average cost is 12. So no matter what you sell, it's 12, right? So if I have any inventory, 450 left in any inventory, and multiply that with 12, this will give me how much? 5,400, right? You follow? If I have 550 that I sold and multiply that with 12, it will give me 6,600, right? This is the average cost. Are you following? No, this is the not for, we are not specifically identifying inventory. This is average cost. This is a third method, right? So you determine the average cost of the item. I have a total cost for all the inventory that is 12,000, and I have 1,000 inventory item units. What is the average cost? 12,000 divided by 1,000, it's 12, right? So whatever I sell, 12, right? So whatever I have left is also 12. So when I calculate the cost of goods sold, I just multiply the items I sold times 12, that's cost of goods sold. If I want to calculate ending inventory, I multiply the ending inventory items times 12. It's 12 no matter what. Is that clear? This is the easiest one, right? You don't have to physically, it's the easiest one to calculate and most unlikely to be on the exam. So, okay. Now, let's go on for just a few more minutes and we'll take a break, inshallah. So this is, oops. This is the physical illustration of average cost where you put something in a place where everything mixes together, right? So you cannot physically, this is a physical example, right? So you put something like petrol or gas or something in a place where the old mixes with the new, and you sell average cost. This physically. You can do the accounting for petrol and gas using first in, first out, or last in, first out. Accounting of it. Doesn't physically have to match the accounting. The accounting is different than how physically it is done. Because if you want to match, then the last in, first out almost is non-existent. But it is the second most preferred method. Are you following? Okay. So if you put these three side by side, right? If everything else is the same, the revenue, the sales price is the same, and all the other expenses are the same, then in the FIFO method, your cost of goods sold is 6,200. In the LIFO method, the cost of goods sold is 7,000. And the average cost method, the cost of goods sold is 6,600. And the net income also changes accordingly. So the net income will decrease if the cost of goods sold increases. Cost of goods sold is an expense, right? So you see the net income in the FIFO method is $2,310. In the LIFO, it's $1,750, and the average cost is $2,030, right? And did we face a situation where prices are increasing or decreasing? In our example, where the price is increasing or decreasing? The price, the cost, the items that we purchase, did we pay more for them every time we purchase, or did we pay less? Did they more, right? Look at the dates, not here, look at your previous slide, right? 10, 11, 12, 13. So every time at a later date, the prices are increasing, huh? You follow? Right? When the prices are increasing and we use FIFO, it gives you a higher net income than LIFO. Do you see that? You see that? Because we are selling the items that we purchased for less first. If the sales price, if what we are selling them for is the same under both methods, then FIFO will give you a higher net income when prices are increasing. The purchasing price, yes. When the prices of items that you sell are increasing, right? If you sell them for the same price, then your net income will be more compared to if you were using LIFO, right? The average cost is always in between LIFO and FIFO. Okay? The average cost net income is always between LIFO and FIFO. Okay. Now, what you have to do, yes, yes. Cost of goods available for sale and cost of goods sold. What is the difference? Cost of goods available for sale is everything that you have for sale. So I have 10 cars, and I have purchased another 10 cars. I have 20 cars available for sale. So whatever it costs me to buy those 20 cars is called cost of goods available for sale. Right? And cost of goods sold is what I have sold.
So if you were like a healthy company making money, your cost of goods sold would have to be less than what you're selling. No, the cost of goods sold would be higher than what you bought the inventory for.
So that
To make money, would you have to buy the inventory in less price than what you're selling it for?
of course.
Yeah, so would your cost of goods sold be higher than?
You're mixing up cost of goods sold with sales price. Sales price is different than cost of goods sold, right? So the sales is always more than the cost of goods sold. Otherwise, you're going out of business,
Yeah.
right? The sales price is different than the cost.
So what's the difference between the cost of goods sold and the cost of goods available for sale?
Let's say I have a pen in my inventory and it costs me 1. I purchased another pen, not very good quality, 1 year. So how much I have in inventory? That is cost of goods available for sale. Cost of goods available for sale. This is always shown in which financial statement? I will fail all of you. The question is, I have sold the inventory, I have the cost. Balance sheet. The cost of goods available for sale is in the balance sheet because I have the inventory available for sale. I did not sell anything yet. It's inventory, the cost of inventory is sitting in the balance sheet. Now I sell this 1 pen for $2. This is my sales price. I sell it for 2 riyals. What is my cost of goods sold? 1 riyal.
You still
I sold it for 2 riyals. How much did I buy it for?
1 riyal.
1 riyal. How much is my gross profit?
1 riyal.
So cost of goods, cost.
What it costs to buy it.
Oh, cost for buy, cost of the goods that I purchased, right? Cost of the good sold. This is, what is this to you?
Same.
Tell me where is this
Sales
number?
revenue.
Sales revenue. I sell it for 2 years. I always have to sell it for more than my cost of goods sold, right? If I sell it for 1 riyal, what is going to be my gross profit? I don't need a business to make zero gross profit. I can sit at home and I am making zero gross profit every day. You follow? I don't need to go there. I can relax and make zero gross profit. If I come here, I have to sell this for at least. What is the least denomination? Yeah, I have 5 dirham, it's available. Although I have one. I don't know if you have seen one lately, but the 5 dirham is available, so I have to sell it at least for more, something more than what I purchased it for. Otherwise, I'm going out of business. You follow? There's no point in me doing business if this price is not more than my cost of goods sold. So cost of the goods sold is what I paid for it. The sales revenue is what I am selling for, right? The difference is the general post office, right? GP. Gross profit, not general post office, right? It's gross profit. Okay? Very good. Clear? Okay.
Just to summarize this, if price increase, people only get better.
That is correct.
If price is unchanged, also people will get better. No, I said unchanged.
If prices don't change, which will give you higher income? If I buy everything for 10 riyals, which one will give me higher income? That is correct. None of them will give me higher income because I calculate everything multiplied by 10. Any inventory cost of goods sold units always multiplied by 10 in no matter which inventory method I use because the prices are not changing, right? So if the prices don't change, neither one of these methods will give you any different income. They will always show you the same LIFO, FIFO, average cost, specific identification. If everything is purchased at the same price and you sell them at the same price, then no matter which one you're selling, profit is going to be the same. No, I am not buying. I am selling for the same price. Cost of goods sold is what? Cost of goods available for sale is what I had at that point in time. I did not buy it for the same price. I, no, your cost of goods sold is not, you cannot ask the question if the cost of goods sold is the same, because the cost of goods sold is the thing that is calculated. The cost of goods sold is calculated based on how many you have sold and how much did you purchase each item for. What's confusing you is the cost of goods available for sale is the same. The cost of goods available for sale is the same Because you had 12,000 items to sell, right? You have 12,000 items to sell. You found $12,000 worth. The total is the same, the total, right? But each batch was purchased for a different price. So when you're selling from each one of these batches, 100, 200, 300, 400 items, and you calculate the ending inventory or cost of goods sold based on those purchase prices on those dates, your cost of goods sold will vary when the prices are increasing or decreasing. Make sense?
For the same number and same price. Prices are decreased for the same number of goods and same price, same cost. That's one.
Still not cost of goods sold. Cost of goods available for sale.
So, the difference of each one, right? According to the cost of goods sold.
Go ahead, go ahead.
I think you need to go back to this one. So you get where we have the ending inventory from, which makes a difference. Because you have the cost of goods available for sale as total. However, when you buy it from on like different prices. But this is the total price. So you need to go back to this slide. This relates to the slide number 14. Yes.
So you can. Look,
Both these we store the same number of goods.
this information that you have up to here is the same no matter what method you use. This is fact. Forget the inventory. Let's see your assessment. And you're buying items, whatever these items are, boxes or whatever it is. At the beginning, you had 100 boxes. Each one you paid 10 riyals for. So first of all, so your inventory is, the cost of your inventory is, on April 15, you purchased 200 more, and you paid $11 for each one. So your purchase price is 2,200. On August 24th, you purchased 300 items, $12 for each. Your purchase price is 3,600. And then on November 27th, you purchased 200, purchase price is $30, and the cost is 5,200. So add all this, your total cost for this 1,000 items is 12,000. Right? This is very good. This is what you have now waiting for the customers to buy. You're sitting in the shop, you have 1,000 boxes of whatever it is, chocolate, 12,000. So far so good. Here, if you sell, forget this, if you sell 100 what is your cost of goods sold? 1,000. If you use which method? If you sell the 100 units, the first 100 units, which method are you using? First in, first out. Your cost of goods sold is how much? No problem. If you are using last in, first out, then which 100 are you going to sell? From here, right? What is the price of 100 units? Listen, I'm selling 100 from here. What is my cost? I'm using last in, first out. 1,300. You follow? Right? So if I'm using first in, first out, my cost of goods sold will be calculated from the top. And I'm saying I'm using last in, first out. I'm still selling 100 items. This 12,000, 1,000 never changes. But my calculation of cost of goods sold will be changed because I am considering the first 100 to sell first under FIFO, and I'm considering the last one to sell under LIFO. Good. If I am using average, 12,000 units divided by 1,000, the average cost is 12. If I sell 100, then my cost is going to be 1,000. You follow? So 1,000 in FIFO, 1,300 in LIFO, 1,200 in. Here, same concept applied with the numbers again.
I have a question just following.
Yes.
So, when the price is increasing, you use FIFO. Because it makes.
You use one method, whatever method you have.
No, I don't know. You will get more profit
If you use FIFO, prices are increasing,
yeah, the prices are increasing.
then you will have more income because your cost of goods sold is always going to be less because
You're taking the
you take the
less
margin.
expensive one.
Generally, over a long period of time, most companies use FIFO. Why? Because most prices are always increasing. Prices of things are always increasing. Follow. 40 years ago, in Riyadh, I purchased a short one for 1 year. In Riyadh, 1 year. It's saying the outside. Follow. Right? My father used to make 10,000 riyals a month. At that time, I can assure you, I will make 10 times that. You follow what I'm saying, right? So, prices are increasing, but the salaries are not able to keep up with the prices, right? So, prices over a long period of time are always increasing, right? And FIFO will generally result in a higher income. Is that clear? That's why most companies use FIFO. Okay? Okay, where did I stop? I think we are, let's go back to here where we were. I just want to see if we can take a break now, inshallah. Okay, so let me do this slide and we will take, this is related, and then we will come back to a concept after we take a short break. This is using the method, right? Mariam, what you were saying is, if you decide that you're going to use FIFO or LIFO, then you have to stick to that from year to year so that your company can be compared with your last year's performance and be compared with your current year's performance as you go forward. You are allowed to change the method if you think that it is going to cause your company to report better, if the accounting will be better. And there is a process of doing that. but you cannot switch back and forth between methods year to year depending on whether the prices are going up or down, and then you want to show high profit, low. You can change, but then you have to stick to that, right? The bodies that control the accounting and reporting will not allow you. You have to go through reporting, you have to get the authorization and so forth. So you cannot go back and forth. They will not allow that. Okay? It is possible to change, but it cannot be changed frequently. Okay, so we'll stop here, inshallah.